What is one of the best tools online for visualizing how your portfolio might perform in the future? That's going to be the topic of today's video. Now, Portfolio Visualizer, which is included in the link below, is one of my favorite tools for looking at how assets have performed over different periods of time. It does have its faults because typically it only starts from 1972, and also some of the assets it looks at only start from the 1990s, early 1990s. But nevertheless, it allows you to compare several different portfolios. So you could have portfolio 1, which is 100% in US stocks, portfolio 2, which is maybe 50-50 with bonds, portfolio 3, which is like Ray Dalio's or Wearer portfolio, and so on. And what's very interesting about that is if you look over any kind of long period of time, you can see some incredible trends. So for example, on my email list campaign, which I did last time, I actually looked at different portfolios for people who had subscribed on my list. And basically, if you compared something like Ray Dalio's or Wearer portfolio, or the so-called permanent portfolio, compared to 100% in US stocks, you see something incredible. Yes, it's less volatile, right? Because if you're in many different assets like gold, stocks, bonds, all those kind of assets in one portfolio, it's definitely less volatile. However, you could be losing a lot of money long term. So for example, if you started out with $10,000 in 1972 and put it 100% in US stocks, and investor 2 put that $10,000 into something like the permanent portfolio, which is 25% in stocks, 25% in bonds, 25% in cash, 25% in gold, or indeed Ray Dalio's or Wearer portfolio, they would have had about 800,000 or so less today. However, the worst year wouldn't have been that bad, whereas the first investor would have had years as good as 40% and years as bad as 37%. However, that extra volatility long term didn't make a huge difference. And what's also interesting about looking at that, the portfolio visualizer, it really shows some trends I've been talking about before, like emerging markets don't necessarily beat developed markets, especially US markets, but it also shows that during certain periods of time, of course, all assets can be stagnant. So for example, from 2000 until 2010, the US market was stagnant, whereas the Chinese market and emerging markets in general were going crazy from 2000 until 2006. So you can also look at different decades, different time periods, and so on. So I would encourage you to check it out. I'm not affiliated obviously in any way with Portfolio Visualizer, but check it out. That doesn't mean you should expect those returns in the future. It also doesn't mean you should be 100% in stocks forever. However, I think if somebody's relatively young, or very young especially, being 100% in stocks is not a bad idea. As long as you diversify later on when you're close to retirement, you're almost for sure going to beat bonds and indeed a mixed portfolio being in stocks, especially if you're in the ETFs and the indexes themselves. Because let's face it, if the market goes up, you're going to benefit. If the market is stagnant for 10 years, you're going to buy cheaply for a period of time, right? So diversification is a good tool, especially when you're close to retirement or even maybe 10 years towards retirement. It's also good for the nerves, right? Because many people can't deal with, say, a 40% fall. But overall, it can be a bit overrated if somebody's quite young, is willing to be aggressive, is willing to hold tight if markets fall. In comparison, I think a lot of people assume that volatility and stability are always linked. And they're not always linked at all. Sometimes they can be, but for example, going back to Portfolio Visualizer, emerging markets have been more volatile than US markets. The worst year for emerging markets has been minus 52% compared to minus 37% for the US stock market. But the average performance has actually been worse for emerging markets. So that's interesting. In that case, you could say, okay, well, that shows it could be more risky. But then if you look at the Nasdaq's been more volatile than almost any other stock market. It's been just as volatile as the emerging markets, yet it's outperformed all our indexes, including the S&P 500. So these simple rules of thumb that many people historically made, like, oh, if something's more volatile, it's more risky, that's just not the case long term. Volatility and stability aren't always linked. It's a bit like political systems as well. When the Soviet Union collapsed, I think everyone was amazed because they thought, oh, it's so stable. But it wasn't stable, it was just non-volatile, right? And there's a huge difference between non-volatile and stable. And the same thing with financial assets. There are some fixed return assets which are very risky, not all of them, but some are super risky. A good example is if you put your money in the Zimbabwean financial system, you're going to get a fixed return, but it's very risky, right? Just because it's non-volatile, it's exceptionally risky. So that's very interesting. If you kind of play around with tools like Portfolio Visualizer, you'll see that some of the kind of generalizations that people make, some of them are just not true at all, right? And people always assume that things like, the property funds will have done better than the stock funds. But again, if you play around with the tool, you'll find that's not the case. So what I would say to people is always have a mind on the historical returns. Never assume they're going to be repeated. They might be, or they might be better than they were historically because of, 0% interest rates lasting for longer, or they might be worse. But by the same token, I think it's good to bear in mind what mistakes people have made in the past. And I think being overly diversified, too young, too soon has been a mistake too many people have made as well. How can I help you? In two ways. First of all, are you an expat, a high net wealth individual, or just somebody who lives in a part of the world where it's difficult to get access to quality investment solutions? In which case, go onto my website on adamfayed.com and find out more. If you don't fit into any of those categories, then in which case there's a range of free material on my website, on this YouTube channel, and indeed on my Quora, where I get over 200 or have received over 231 million views in the last few years. And finally, if you want to actually read my thoughts in more detail, go onto Amazon and find my book on there.